3 weeks ago, I noticed something in a data set that I almost scrolled past. A number on the Shanghai Futures Exchange Vault report had changed. Not by a little, by a lot. So I opened a spreadsheet and started tracking it day by day, then week by week. And what I found pulled me into a rabbit hole that I have not been able to climb out of since. If you own physical silver, if you hold mining stocks, if you have been watching the price crash and wondering whether you made a terrible mistake or whether something else entirely is going on, this video is going to answer that question. I am going to walk you through exactly what I found in the order. I found it so you can see what I saw, and somewhere around the 12-minute mark of this video, you're going to hit a piece of information that will make you pause and rewind. I know because that is exactly what happened to me. It started with one chart. Welcome to the hidden economy. If this analysis opens your eyes to something the mainstream missed, hit like and subscribe. It helps the algorithm put this in front of the people who need to see it. The Shanghai Futures Exchange, the SHFE, publishes its vault inventory data. This is not opinion. This is not analysis. It is not some guy on the internet guessing. This is the exchange itself reporting how many tons of physical silver are sitting in its warehouses. Real bars, real vaults, audited numbers that get updated daily. I went to CEIC, one of the most respected economic data platforms in the world, and pulled the time series. In mid-December 2025, the SHF reported approximately 900 tons of physical silver in its vaults. The number I saw on February 4th was 423 tons. I stared at it. Then I refreshed the page. Same number, so I pulled the previous day, 449. The day before that, 462. The day before that, higher still. I went back day after day after day. Every single entry was smaller than the one before it. Not most days, not on average. Every single day the number went down. I pulled 6 weeks of data and could not find a single day where inventory increased. That is not a fluctuation. That is not seasonal. That is a one-way door. Silver is walking out of those vaults and not coming back. Let me make sure you actually feel the scale of what I am describing, because numbers without context are just noise. 900 tons to 423 tons in 7 weeks. That is a 54% drawdown. More than half of China's main exchange silver vanished in less than 2 months. The weekly drain rate is 42.6 tons. The daily drain is 10.78 tons. And if you overlay the chart, the angle of decline is getting steeper, not flatter. The drain is accelerating. Now put that in global context. Combine the SHF vaults with the Shanghai Gold Exchange vaults, and you get roughly 900 tons total across all Chinese exchange accessible silver. That is 29 million ounces. Sounds like a lot until you realize that the world consumes over 1.2 billion ounces of silver per year. All of China's exchange silver covers 2.4% of 1 year of global demand. 2.4%. That is not a cushion. That is fumes. Now, I'm going to do something that none of the articles about this data did. I am going to run the math forward. If the drain rate holds at 42 tons per week, and current inventory is roughly 412 tons, according to the latest improved terminal data, then you divide 412x 42, and you get 9.8 weeks, call it 10. In 10 weeks at the current rate, SHF silver vaults hit zero, not low, not concerning zero empty shelves, nothing left to deliver against futures contracts. Now, if you are sitting on physical silver or silver miners right now and you just watched a 53% price crash, I need you to understand what this number means for you. The exchange that backs stops a huge portion of Asian silver price discovery is running out of metal. I am not predicting this will happen. Drain rates can change, metal can flow back in, but no one in the mainstream financial press is even running this calculation, and that alone tells you something about the quality of the coverage you're getting elsewhere. Now, Here is where my research took its first unexpected turn. I wanted to know if this was just a China story. Maybe Chinese industry is pulling metal for solar panels and electronics, and this has nothing to do with anything bigger. That would make sense. China is the world's largest consumer of industrial silver. Case closed, right? So, I pulled the COMEX data and my stomach dropped. COMEX is the main silver futures exchange in the United States, run by the CME Group. It is where paper silver gets traded, and where theoretically you can demand physical delivery. According to data reported by the Kube letter and confirmed by multiple sources, COMEX silver inventory dropped to 415 million ounces in late January 2026. That is the lowest level since March 2025, a 34 million ounce drawdown from its recent peak. But here is what really caught my attention. According to detailed analysis from Shift Gold, the registered silver on COMEX, and registered means the metal that is actually earmarked and available for delivery against futures contracts, has been seeing major outflows since September 2025. Eligible metal, which is metal stored in COMEX-approved warehouses but not yet designated for delivery, is being converted to registered just to satisfy the demand from people standing for delivery. And here's the critical part. The exchange is not bringing in new metal. No fresh silver is arriving in the vaults. They are simply reclassifying what they have. It is like a restaurant running out of food and renaming the appetizers as entree. The menu looks full, but the kitchen is empty. So it is not just China. COMEX is draining too. 2 of the 3 largest visible silver inventories in the world are losing metal at the same time. At that point in my research, I did not want to check the third because I already suspected what I would find. I went to the London Bullion Market Association data. The LBMA operates the largest physical precious metals market on Earth. And according to analysis published by AU Bullion Canada and multiple precious metals researchers, the LBMA's estimated free float, the silver that is actually available to settle London's massive unallocated accounts, has collapsed to what one source described as the lowest level in modern history. According to a detailed report on Trading Key, for the first time in modern history, all 3 major transparent silver inventories, Shanghai, COMEX, and London, are draining at the same time at record speed. The report estimates that nearly 1 billion ounces of refined silver have vanished from visible stocks since 2021. Now stop. I need you to hold those 3 facts together. Shanghai draining, COMEX draining, London draining. Same direction, same time, same metal. There is no historical precedent for this. If this were happening to oil, it would be the lead story on every financial network in the world. If this were happening to copper, congressional hearings would be scheduled by Friday. But it is silver. So, you are hearing about it from me at midnight on YouTube instead of from the front page of the Wall Street Journal. And honestly, that is part of the story too. So, the next question is obvious, and it is the one that kept me digging until 3 a.m. in the morning. Who is taking the metal? Because silver does not evaporate, it does not dissolve. When it leaves an exchange vault, it goes somewhere. Someone signed a delivery warrant. Someone arranged armored transport. Someone has those bars. And whoever it is, they are doing it simultaneously across 3 continents. Let me tell you what I found on the COMEX side. And I want to be honest about what is confirmed data and what is my inference. On January 7th, 2026, a single day of COMEX deliveries moved 8.1 million ounces of physical silver. According to detailed analysis from Jensen David's Substack, JP Morgan delivered 99% of that total. One bank, 8 million ounces, one day. But here's what broke my brain. After that massive delivery, you would expect demand to cool, contracts fulfilled, buyers satisfied, open interest declining. That is how delivery months normally work. But that is not what happened. Open interest went up. New buyers were piling in as fast as the old ones were getting filled. And according to analysis from Money Metals, something even stranger was happening in the background. Traders were rolling contracts backward, taking March delivery positions and pulling them into January and February. In normal markets, people roll forward to delay. Here, they were paying extra to accelerate. They wanted the metal sooner, not later. Now, the simplest explanation is that they do not trust it will be there if they wait. One analyst quoted by Money Metals put it bluntly, "If this is what is happening, the comics could end up in big trouble." Now, let me take you back to China because while the vaults were draining, something else was happening that changes the entire interpretation of the story. And this is the part where I went from thinking, this is interesting, to thinking this is deliberate. On January 1st, 2026, China's Ministry of Commerce implemented new export controls on silver. I went to the original MOFCOM announcement and cross-referenced it with CNBC's reporting. According to CNBC, the state-run Securities Times quoted an unnamed industry insider who said the new policy formally elevates silver from an ordinary commodity to a strategic material. Let that language register, strategic material. Same regulatory footing as rare earth metals. The same category China used to bring the West to its knees over magnets and semiconductors. Under the new rules, only 44 large state-approved companies that produce at least 80 tons of silver annually and maintain $30 million in credit lines are permitted to export. According to FX Street's analysis, this effectively restricts 60 to 70% of the world's refined silver supply to domestic Chinese use. Hundreds of smaller and mid-sized exporters who had been supplying silver to global industrial users for decades are now locked out overnight. Tesla CEO Elon Musk responded on his platform X by writing, "This is not good. Silver is needed in many industrial processes." According to CNBC, within days of the announcement, 2 Chinese companies contacted Canada-based Kuya Silver, offering to buy physical silver at $8 per ounce above market price. An Indian buyer followed the next day, offering $10 above market. That is how you know a restriction is real. When buyers start calling miners in other countries and offering premiums just to secure metal, China did not ban silver exports. That would have been too obvious. It did something more effective. It created a licensing bottleneck so narrow that most of the world's silver refining capacity is now functionally landlocked inside Chinese borders. Now follow this timeline with me, because this is where my investigation changed direction entirely. I started mapping the vault data against the policy dates, and a pattern emerged that I was not expecting. October 2025, China's combined SHF and SGE vaults held roughly 1,190 tons of silver. That was the starting point. By November 21st, just 51 days later, those same vaults held 519 tons. According to Oben's detailed analysis, 670,000 kilos of silver disappeared in under 2 months. That is 21.55 million troy ounces. And here's the detail that stuck with me. On November 21st alone, another 15,819 kilgarn were removed. The price of silver was falling that day, not rising, falling. Normally, when price drops, sellers appear and buyers retreat, but someone was pulling more metal out on a down day. That is not speculative behavior. That is strategic accumulation by someone who does not care about the daily price because they are operating on a completely different timeline. Then something strange happened in December. SHF saw a 129-ton inflow, the highest monthly inflow in 17 months. It looked like the drain might be reversing. Some analysts breathed a sigh of relief, but it did not reverse. By mid-January, the drain resumed harder than before, and it has not stopped since. Here's my honest interpretation of this pattern, and I want to be clear, this is me connecting dots, not stating confirmed fact. China restocked its exchange vaults briefly in December, right before the January 1st export controls went into effect. Metal flowed in during December. Then the export door slammed shut on January 1st, and now the metal is flowing out again. But this time it cannot leave the country. It is staying inside China, being moved from exchange vaults which are visible in public to somewhere else. Industrial facilities, government stockpiles, military reserves. We do not know exactly where because that data is not published. But we know it is leaving the exchange system, and we know it cannot leave the country. Someone is moving silver from the public ledger to the private one inside a closed system. Now, while all of this was happening, so it's the only investment vehicle available to Chinese citizens who wanted silver exposure, was being systematically shut down. The UBS SDIC Silver Futures Fund is the only publicly traded fund in China that invests directly in silver futures. I want to ask you something before I continue. Look at those 4 steps: export controls, vault drains, fund lockouts, Western price crash. Do you think that sequence is a coincidence, or does it look coordinated to you? Tell me in the comments, because what I'm about to show you next made me pick a side. I want to show you a historical parallel that made this entire investigation click for me, because patterns matter more than predictions. In 2005, China began stockpiling copper at a pace the world had never seen. Exchange vaults drained. Prices were still manageable. Western analysts scratched their heads. Why is China buying so much copper? The answer became obvious within 18 months. China was building strategic reserves ahead of the largest infrastructure build-out in human history. They were buying everything they could at every price they could manage before their own demand made the metal unaffordable. The copper price did not double. It tripled within about a year. And by the time the rest of the world figured out what China was doing, it was too late. The metal was gone. The reserves were built, and the new price reflected a world where China held the inventory and everyone else held IUS. Now look at what is happening with silver in 2026, and tell me if the pattern does not look identical. A vault drawdowns accelerating, export controls locking refined supply inside the border. Only 44 state-approved companies allowed to ship anything out. Retail investors blocked from competing through fund suspensions. The paper price suppressed through a combination of margin hikes in the West and fund lockouts in the East. The playbook is the same, but the stakes are higher, because in 2005, copper was not simultaneously being designated a critical mineral by the United States, discussed for international price floors by 55 nations, and about to be remonetized by the world's largest democracy. Silver has all of that, and the vaults are emptying faster than copper's ever did. Now let me give you the number that ties this entire investigation together. And this is the part I told you about at the beginning, the part that made me pause and rewind my own notes. China's export controls went into effect January 1st. At the current SHFE drain rate of 42 tons per week, the vaults approached zero around mid-April. I checked that math 3 times, mid-April. Then I looked at something completely unrelated. India's Reserve Bank has issued new regulations allowing silver to be used as formal bank collateral effective April 1st, 2026, the first remonetization of silver by a major economy since the 1800s. 1.44 billion people gaining access to silver as a monetary asset. I looked at the 2 dates side by side. The week the Chinese vaults approach empty is the same week India goes live with silver as money. I sat back from my screen and did not type anything for about 5 minutes. I did not manufacture that convergence. I did not cherry-pick dates to make a narrative. I ran a drain rate forward on a calculator and checked a regulatory calendar, and they landed on the same week, April 2026. Chinese vaults approaching zero. Indian monetization going live. The world's factory running out of visible silver at the exact moment the world's largest democracy tells its population that silver is money. When I saw that, I understood that this story is not just about inventory data. This is about a once-in-a-generation restructuring of who holds silver, in what form, and under whose rules. Now, let me tell you what this means if you are invested in silver. Because data without implication is just trivia. The paper price, the number you see on your screen, the number that made you sick when it hit 57, that price is set by exchanges that are running out of the physical metal they need to back those prices. SHF approaching zero. COMEX registered bleeding since September. LBMA free float at historic lows. When the physical runs out, the paper price stops being a market price and starts being a fiction, and fictions do not survive contact with the delivery notice. The question every silver investor should be asking right now is not where is the price going this week. It is what happens to price discovery when the vaults that underpin it are empty, because that moment is not theoretical. It is 10 weeks away on the SHFE side, and no one on mainstream financial television is even discussing it. There's a line from the AU Bullion Canada analysis that I have not been able to get out of my head since I read it. They wrote, and I am paraphrasing to respect their work, that when the last readily available bar leaves the vault, the price discovery mechanism shifts from whatever the paper market can bear to whatever it takes to pry the last ounce out of private hands. Read that again, whatever it takes. And every day, the number of bars between here and that moment gets smaller. Shanghai is at 412 tons and falling. COMEX registered is bleeding out since September. London's free float is at a level that multiple analysts describe as the lowest in modern history. The 6-year structural deficit has not reversed, and the world's largest refiner just welded the exit door shut. The question is not whether the vaults will empty. At this trajectory, the question is, which vault empties first? I want to leave you with a question, not an answer, because I think this audience is smart enough to draw their own conclusions, and I would rather arm you with data than opinions. If you were government or sovereign wealth fund or state-linked industrial conglomerate, and you knew that silver had just been designated a critical mineral by the United States discussed for international price floors by 55 nations at the State Department, and was about to be formally recognized as money by the world's largest democracy, and you also knew that you had just locked 60 to 70% of global refined supply inside your own borders, what would you be doing right now? Would you be selling? Or would you be quietly moving every bar you could get your hands on from a public exchange vault into a private one while the rest of the world watches the paper price and thinks the trade is dead? The vaults do not lie. They publish the numbers every day, and every day the number is smaller than the one before. Silver is not crashing because nobody wants it. Silver is crashing because someone wants all of it, and they need the price low enough to take it before the rules change. If you held through this crash, you are not wrong. You are early to a game that the rest of the world has not figured out yet. The data is on your side. The vaults prove it. And in the next video, I'm going to show you exactly what happens when those vaults approach zero and the paper market collides with physical reality. What I found will change how you think about the price you see on your screen. I will keep watching. I will keep tracking every vault report, every CEIC data point, every delivery notice. And when those vaults approach zero, I will be here to show you what happens next. 10 weeks. The clock is running. This is not financial advice. This is what the data shows. What you do with it is your decision.